When my book, Pricing for Profit, first came out and I rebranded my company on pricing, the brand promise that I made was to help companies get higher prices regardless of what their competitors or the economy were doing. And I have to tell you, it raised a few eyebrows when I said that. And in fact, one of my friends, longtime friends, said to me, "You know, Dale, I've known you a long time and I've been amazed at some of the things you've been able to accomplish, but I got to tell you, I'm having a hard time buying into this one." And that really got me to thinking, why is it that people are so skeptical of the ability to get higher prices regardless of what their competitors or the economy are doing? And I think I've traced it back to a concept that most of us have heard one way or another called price elasticity. And some of us got that through economics courses in college, but most of us have heard about it through other business associates that we have, and the fact that they're talking about, the fact if you lower your prices, your unit volume sales go up. And that's, price elasticity says that all other things being equal, that's what's going to happen. If you lower your price, you're going to have greater volumes of unit sales. And so most companies looking at price elasticity are looking at this part of the curve. And they're trying to determine where on that part of the curve to set the price so that they're going to optimize the revenues and the profits that their company's going to get. And what I'm going to suggest is that's the wrong question. We shouldn't be asking, how do we get on that part of the curve? We ought to be asking, how do we get on the vertical? How do we make price irrelevant? And what pushback do you think I get when I make that suggestion?
They won't buy.
They're not going to buy, right? That the volume is going to be low, right? If we're based on this concept and this curve, it's going to be low volume. But is that really true? Is it true that we experience lower volumes if we have a high price? And to answer that question, I looked at 4 publicly traded companies, 2 with high price strategies and 2 with low price strategies. And before I tell you which companies those were, let's talk about the economy. When I did this analysis, I specifically chose the years 2009 to 2012. And the reason was that in 2007, when the subprime bubble burst, in 2008, most companies, even the big brands like Kraft Foods and Procter & Gamble, they were sitting on their hands and not doing anything with the pricing because they wanted to see what the consumers were going to do with their spending. And so they were sitting on their hands. In 2009, June 2009, the economists said the recession ended. Early 2010, the stock market was just beginning to rebound, but everyone's 401ks and their home values were still in the tank at that point. Unemployment was still around 8.7, 8.8%, about 60% higher than normal. And we were getting bombarded on a daily basis with stories about countries in the European Union possibly defaulting on their debt. And there was question about whether or not the euro was going to survive. So a lot of uncertainty, a lot of fear, a lot of anxiety going on at this point in time. That's why I chose these years. Now here are the companies that I chose. Apple and Panera, that are 2 high-price strategy companies, and Amazon and Walmart, 2 low-price strategy companies. And I looked at their financial results during this period of time. And the company that outperformed all the others, Apple, 44.3% compound annual growth rate in revenues. And their operating margin, their profit after operating expenses, grew from 23% to 37%, a 63% improvement. Now, the company that came in second in terms of revenue growth was Amazon down at the bottom, 26.3%. But if you notice, from an operating margin standpoint, they had a decline of almost 30%, from 6.6% to 4.6%. So they gained a lot of revenues, but it cost them heavily. The company that came in third was Panera, And Panera grew at 10.7% compound rate in their revenues, and they had a 2.2% improvement in their operating margins, which was an overall 14% improvement from where they had been. Again, very significant growth in both the revenues and the profits. And one of the things that's not obvious from this information is that Panera was one of the few companies that raised their prices throughout the recession on a consistent basis. They consistently raised prices throughout the recession. And the final company is Walmart. And Walmart grew at a compound growth rate of 3.5%, and their operating margin grew by a paltry 0.1%. And again, one of the things that's not obvious from these numbers is that during this time frame, Walmart experienced 9 consecutive quarters of declining sales in the US. And when they turned it around, that 10th quarter, they gave up 2.3% of their margin in order to do that, roughly 10% of what their margin had been in order to turn that sales decline around. So with this in mind, with this evidence, does the economy really matter? This is contrary to what we'd expect, right? If there was ever an economy that we would expect people to conserve their money and spend it only on necessities, this would have been it, right?
Right.
The worst economy in 7 decades. And yet, what do we see? People waiting in line to buy high-priced iPads and iPods, right? Nobody had, everybody could have survived without them, but people are standing in line to get them in the worst economy in 7 decades. Nobody had to eat out, and yet people are going to Panera and paying premium prices and escalating prices during the worst economy in 7 decades. And the companies that are using low price strategies aren't experiencing as much revenue growth or profit growth as the high price strategy companies. So that's why I say the economy doesn't matter. People are going to spend money on what's really important to them, what they want. And they'll find the money, and they'll forego other spending, but they're going to spend the money on what they really want. So the economy doesn't matter. And then we can see here that these companies got higher prices. There are a lot of restaurants out there, right? Panera's got a lot of competition, and yet this is the kind of growth they saw while they were raising prices during the high price recession. The one thing that people tend to forget about price elasticity is the qualifying phrase at the beginning. All they remember is if you lower your price, unit sales go up. What they forget is the qualifying phrase, all other things being equal. And my contention is that it's our job to make sure things are not equal. It's our job to tilt the playing field in our favor. And if we do that, then it really doesn't matter what the economy is doing. It really doesn't matter what our competitors are doing. You're going to be able to get premium prices for your product or service. Okay, before we turn this over to some questions, here's another resource for you. My website, pricingforprofitbook.com. You'll find almost 300 blog posts on there for pricing, branding, marketing, and sales, because they're all essential elements to getting premium prices. There are some white papers out there that are free, including one that on the fact that low price strategies subvert economic growth and employment. And there are some ebooks on the 5 elements that are needed to get an effective premium pricing strategy. And there are some of the other books that I have available as well. And with that, I'm going to open up to questions. Mark? There is some difference, and there are some people who are buying that higher level. In reality, there are only 3 things that anybody buys: image, innovation, and time savings. So depending upon how much they value image is going to dictate how much they're willing to pay for the product or service that you have available. So somebody that's willing to spend money on a Mercedes or a Hummer, values that image a lot more than somebody that's driving a Camry. All right, so yeah, it depends on that, but it depends less on the product or service, but on the image that it portrays and how it ties to their image, or to the innovation, how important innovation is to them, or how much they value their time. So if you get somebody that's making $100,000 a year and you got somebody else making $20,000 a year, they place a great deal of difference on the value of their time. The ones making $20,000 a year are more likely to be do-it-yourselfers, where somebody making $100,000 a year is more likely to contract for services that other people are doing on their own. So those are the key elements there. And with every product that you have or service that you have, especially products, there are a lot of similar products out there, but we can always add services to it that create value. And they're typically very small things that we have to do in order to create that value. Unfortunately, our tendency is when we create those is to give them away because it really doesn't cost us much or take much time to do that. But we're adding great value, we're not recognizing it for the value that we're providing, and consequently we're not getting compensated well for it. And so when we learn to look at that additional value we're providing by solving a problem or creating a better user experience for our customers, they will pay for that. They'll pay extra for that. Years ago I had a construction client, and one of the things that we discovered was that there was an industry-wide problem in that the contractor would land on the job site with their crew, 10-person crew and all their equipment, and the superintendent for the customer would ask for changes and then refuse to sign a change order. So the option was, pack everybody and everything up and go home and not have anything to do that day, or go ahead and make the changes and bill it and then try to work it out later. Well, working out later meant that they were waiting 75 days or more for their money, and they'd give up half the change order revenues. And all we did to correct that problem, to solve that problem, was create a 2-paragraph memo, because what we realized is that we were surprising the home office. The superintendent wasn't conveying that information to the home office. So in those situations when the superintendent refused to sign, the foreman would call my client's office, the estimator there, and tell them what changes have been requested, and they'd create a 2-paragraph memo that said, these are the changes that have been requested, this is what it's going to cost, we're going to proceed unless you tell us not to, and we faxed it to the corporate office. A 2-paragraph memo. Within a month, they didn't have any receivables over 45 days old. They freed up $350,000 worth of cash, and they started to get calls from contractors that they couldn't get in to see before, because the word on the street was, you're not going to get surprised, you're not going to have to waste time negotiating. Simple things, and we all do a lot of simple things to help our customers, and they add tremendous value. We just need to get compensated for it. Other questions? Yes, Les?
Yeah, Dale, some examples of that?
Well, the way that I approach it is that I look at the problems that my client is experiencing and what problems their customers are experiencing, and we look at a way to solve that. Because it's going to save my client time and money. It's going to save their customer time and money. So that's what we look for. And we find ways to fix it. And typically, they're small things, they're simple, they're inexpensive, easy to implement. And then we start calculating the value. Well, how much time is it saving them? What does that mean for their bottom line? And then we base the pricing on that value. Does that make sense? Okay, with that, we're out of time. I will hang around after the session, so if you have questions, I'll be happy to answer them. And if you want, send me an email or give me a call. I'll be happy to answer them.